Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. I'm Kelvin. I hope that you all have a very great and restful weekend. Welcome to today's Daily Dose, and today will be the start of a brand new month, Monday, 2nd of September 2024. So before we jump straight into today's details of the Daily Dose that to share with you guys, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, no financial advice or recommendation for any investment product, as well as any forecast prediction in or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so now before we jump straight into the short-term intraday technical outlook on the broad-based cross asset classes for today, let us have a quick recap of what has taken shape on Friday and as well as on the weekend in terms of news flow and their impact on the various broad-based cross asset classes. So let us take a memory down on last week economic calendar. So last Friday, not yesterday, last Friday economic key data release during the US session, as you see on my screen over here, was the core PCE price index. Okay, why this index is important? Because this is one of the key inflationary gauge that the US Federal Reserve will tend to be a preferred choice to determine the inflationary trend condition in the US. So as we know that more likely, or I would say that high odds that the US Federal Reserve will kickstart their interest rate cut cycle in the upcoming FOMC meeting in this coming September, for the month of September. So that could be either likely a 25 basis point cut. Later I'll share with you on the CME Fed Watch 2, okay, the in terms of the probability. So what's important over here is that US inflationary condition has been determined by this core PCE price index on a year-on-year basis continues to actually inch downwards, matching almost the same pace of deceleration at 2.6% year-on-year printed in the month of July, unchanged from 2.6 seen in June, slightly below market expectation of 2.7%. That is 1 basis point lower. So if you look at the trend of the core PCE price index from a trend perspective, it continues to actually decelerate. All right, so if you look at from the 5-year trend, ever since hitting the high of 5.47% in September 2022, so for the last 1 and almost 2 years, I would say that it continues to actually temper off. And despite the fact that it kind of made market expectation, so that doesn't actually create a big surprise on the FX market, as we know that this inflationary trend continues to plummet. It implies that the US Federal Reserve has more reason to actually cut interest rate. Dollar weakness, and this dollar weakness has been present since 1.5 weeks ago, I would say 2 weeks ago. Okay, also kind of commented during last 2 weeks, 2 Friday ago, Jerome Powell Jackson Hole speech that more or less give us a high probability that the Fed will start cutting rates in September. So given that the inflationary trend, the PC inflation trend didn't actually fall off that much off the cliff, that means it's still hover at 2.6%, not 2.5 or 2.4%. That's why we do not see the dollar weakness have a follow through on last Friday after the release of this core PCE price data. And in fact, the opposite takes shape, where we start to see the dollar rally across the board, all right, based on the 5-day rolling performance basis over here as of we are speaking right now. So the dollar in fact strengthened across the board, what we could see over here. So this is something like the market has already priced in this US Federal Reserve dovish stance in terms of starting that interest rate cut cycle in September. Nothing new. So the PCE data just supports this interest rate cut policy, also nothing new. And the only thing new over here is that the inflationary trend US didn't actually fall down as much as beyond what its market is expecting. All right, so it's almost having the same pace at 2.6% year on year, as being indicated by the previous month of June as well. That means for the month of June and July, almost the same pace at 2.6%. All right, so that actually didn't actually create that further ammunition to see a slide in the dollar. So we know that FX market or any tradable market, they don't move linear, they move in a non-linear fashion. So that's why we tend to see this kind of mean reversion, rebound, or decline taking shape upon the release of, or after the release of such key economic data that more or less come within market expectation. All right, so now with that, let us look at the CME Fed Watch 2. So for those who join us for the first time, what is this CME Fed Watch 2? So this CME Fed Watch 2 is actually compiled by the CME Exchange Group. So what they did over here is that they actually look at the current, I would say that the current and the forward other months down the road Fed funds futures pricing contract. Based on the calculation, we could actually deem or a kind of a extrapolate what is the Fed fund futures market looking at in terms of probability whether the Fed will be cutting or hiking, and by how many basis points in the upcoming US Federal Reserve meeting. So just Google over here. So if you look at this point in time, 18th of September, all right. So let's take out step by step for those who are actually very first time seeing this CME Fed Watch 2. So we know that the current target rate for the US Federal Reserve Fed Fund rates was at 5.25% to 5.5%. So this rate has been very similar at a high level for close to about more than a year or so. So right now, market is still expecting a very high odds of 69 basis point, 69% chance, pardon me, of only a 25 basis point cut. What do I mean by that? Because you look at 5.25% and 5.5%, 69%. Assigned to 5% to 5.25%. This is the new Fed fund rate after 18th of September FOMC meeting with a 69% chance of hitting this rate. That means it implies a 25 basis point cut. Only a kind of a small chance of 31 basis point at 4.75% to 5%. All right. That means 50 basis point cut will be a very low ball odds at this point of the juncture, taking into account of last Friday PCE price data release. All right. So what we could see over here, this data odds is live, it's not static, so it's actually determined on SS. When new data points starts to come in, this particular odds will start to shift as well and potentially impact the volatility of the FX market and somehow also the volatility of the US stock market in terms of their short-term fluctuation movement. So as we go by, later I'll share with you at the end of today's daily dose what are the key economic data to watch out for this week that could impact these pricing odds of the US Federal Reserve Fed funds rate, all right, as new data looms, key data looms. So we can actually look at this aggregated tab over here. All right, so this aggregated tab will in fact put into account of the aggregated probability in terms of meeting, and it also kind of move forward down the line for the next 1, 2, 3, 4, 5, 6, 7, 8, 9, the next 9 meeting. All right, going forward. So we could see how the market, the Fed funds futures market, is actually pricing the odds right now. So like I said earlier on, the market for the Fed fund rates is now at 5.25% and 5%, and market has assigned a 25 basis point cut of a higher odds of 69%. And what's interesting right now is that we're now almost split in terms of the magnitude of the next interest rate cut that is likely to come in after the US presidential election, which is to be held on the 7th of November. This is the next FOMC meeting in November. And now it's a coin toss between 50 basis point cut and 25 basis point cut. But market now is tend to skew slightly towards a 50 basis point cut, which is at 59% chance odds, 41% chance odds of a 25 basis point cut. All right, so just basically just simple subtraction. Okay, so if market were to be expecting a high odds of 25 basis point cut, the Fed funds rate will be at 5% to 5.25% in 18th of September. Then thereafter, if you look at 5% minus 4.5%, that's 50 basis point cut, which is a high odds at 58.67%. Then it will end the year with almost 100% chance of another 25 basis point cut based on the current CME Fed Watch 2 or the current pricing of the Fed funds interest rate market right now. 98% chance of another 25 basis point cut to end the year on the 18th of December FOMC meeting, where the Fed fund rate is expected to slip down lower to 4.25% to 4.5%. So what market is expecting right now is 25 basis point cut potentially in the 18th of September meeting, a bigger cut of 50% on the 7th of November meeting, and another 25 basis point cut of I would say that in the 18th of December meeting. So net overall expectation of 100 basis point cut or 1 percentage point reduction on the Fed funds rate before 2024 ends. And thereafter, we start to see continuation of 25 basis point cut in the new year of 29th of January, 90% chance, 81% chance of another 25 basis point cut to bring it down to 3.75% to 4%, and that is coming in at the 19th of March 2025 FOMC meeting, and thereafter another 25 basis point cut to bring it down to 3.5% to 3.75%. Pardon me, yeah, at the 7th of May 2025. All right, so net overall, right, we see a continuation of cuts over here. That means only a 50 basis point cut in the 7th of November meeting, then thereafter a slew of 25 basis point cut all the way until the 7th of May 2025 FOMC meeting. Then thereafter the Fed will start to stampede in the month of June, July, and September for next year. All right, so that is based on the current pricing on the CME Fed Watch 2. That means clearly indication a start of a potential interest rate cut cycle. But the only key thing over here is that the magnitude of cuts may change depending on the incoming latest data that could potentially impact the growth of the US economy and as well as the state of the US labor market as well. So later I'll share with you what are these data to take note of for this coming week. In fact, there are 3 of them to take note of. All right. So with that in mind over here is that what we could see over here is that the dollar actually strengthened. But given the fact that it didn't actually impact much on the US stock market, and in fact the US stock market ended last Friday all in the green, okay, with the SPX and the Nasdaq 100 inching up 1% and 1.3%, the Dow Jones Industrial Average up 0.55%, and the Russell 2000 up 0.67%. And also overall, the S&P 500, the Nasdaq 100, and the Dow Jones, these major 3 of them ended the month of August in positive territory as well. So, but however, if you break down the sectorial performing in the S&P 500, so just have a quick recap over here. We know that okay, let me share with you this particular chart. Okay, so we could go to this chart called barchart.com and search for a stock sector finder under the major market sector sub component web link in the this bar chart website. So it gives us actually a breakdown of the 11 S&P sector that made up of the S&P 500 index. So this could also give us a gauge which particular so-called stocks or sector are leading the market. So you look at from a 5-day perspective, so that's last week performance, very simple, right? The S&P gained by 0.24%, almost unchanged by the end of last Friday. But look at what the top 3 components are. So the top three sectors of the S&P 500 that is outperforming the main S&P 500 index are the financials, the industrials, and materials, up by 2.9%, 1.7%, and 1.6%. And the bottom of the line over here are your consumer discretionary, your consumer services, and your information technology. And this particular so-called bottom part of this sector that underperformed, -2%, -7%, and -1.58%, -1.5%, pardon me, consists of the mega cap technology stocks. All right, so how do I do that? You just go to Finviz, you're able to actually see a breakdown very clearly. All right, so what we could see over here is that the technology sector, which consists of Microsoft, Nvidia, Apple, consumer communication services, Google, Meta, consumer cyclicals, Amazon. All right, so what we could see over here in Toriel performance basis, we start to see last week the mega cap stocks is not leading in the US stock market. In fact, they actually lag, and this I already explained on last Thursday and last Friday, and in fact on the middle part of last week daily dose as well, on the US Treasury yield curve steepening scenario that is taking hold right now, and that could actually see the current laggards, means the current laggards, which is those stocks that are industrial stocks, financial stocks, material stocks, and these particular stocks has higher weightage in the Dow Jones Industrial Average, and some of them in the Russell 2000, now taking a front seat in the US stock market to lead, where the mega cap technology stock will take a back seat indeed. But this is also providing that the latest upcoming US economic indicator doesn't show any signs that US is slipping into a recession, then this scenario could hold. And if you look at from a 1 month perspective, since last Friday it ended exactly the month of August, which is ended in terms of trading days, the top three as well starts to kind of center around the value factor oriented sector in the terms of the S&P 11 sector, where the utilities actually outperform the SPX. So SPX ended last month with a gain of 3.9%, the utilities 5.6%, consumer staples 5.57%, real estate 5.33%. Not too bad for the information technology at 5.16%, but the other two mega cap centric sector, which, oops, what happened? Okay, why it hang? Okay, I don't know why it just, okay, just repeat. The other two mega cap centric sector, which is the communication services and the consumer discretionary, both underperformed S&P by only a positive gain of 2.53% and positive 0.7%. All right, so net what we could see over here in terms of the latest economic data releases as of now is actually supporting value play and Dow Jones Industrial Average, potentially the Russell 2000 as well, outperforming the mega cap stocks, which are heavily centric in the Nasdaq 100 and in somehow also the S&P 500. All right, so with that actually sums up last Friday movement, and on Saturday we do have another key China data that was released on Saturday, which is the manufacturing, the official NBS, which stands for the National Bureau of Statistics, that compile the manufacturing PMI and the services PMI. They label it as non-manufacturing PMI. So for the manufacturing PMI sector, it starts to actually be in a contractionary mode. So in terms of PMI reading, anything reading that is below 50, regardless of what country it is, anything below 50 is representing the manufacturing sector, because it's a manufacturing PMI, is in a contractionary mode, and it slipped down to 49.1 for the month of August, below 49.4 in July, and below consensus of 49.5. So if you look at the trend of the NBS China manufacturing PMI data, we will take a look at the current trend over here. It starts to actually languish since hitting a high of 50.8 in March, and thereafter it starts to actually slowly decelerate, and it has been in a contractionary mode since May this year, 1, 2, 3, then fourth consecutive month. So what we could see over here is that this actually represents China industrial production as well, and we know that since 1.5 years ago, China top policy makers has been allocating lots of resources, and as well as their fiscal policy, expansionary fiscal policy in this high-end industrial production. That means we're talking about EVs, we're talking about semiconductor, we're talking about biosciences or biotech industry to support China economic growth, totally away from kind of they deem as unproductive investment that actually may churn out unwarranted leverage in the economy, such as the property sector and in somehow or another the China stock market as well. But what we could see over here is that China industrial production has started to create a bit of overcapacity. That means, i.e., yes, they try to sell as much to the rest of the world, but it all depends whether the rest of the world wants to absorb such overcapacity products. So it seems to us that right now, this exports up from China as being deemed by the manufacturing PMI data has started to show signs of slowing down, which means, i.e., the China top policymaker got to come out fast with another kind of physical stimulus strategy to actually jumpstart the Chinese economy, and do not forget they actually assign a 5% or so target growth for 2024. And given this state of contractionary mode for the consecutive for 4 months as being seen in the manufacturing PMI data, that could actually increase the odds of the China economy not hitting the 5% growth target for this year as being set up by the Chinese top policy maker. So if you look at the services sector, okay, so on the services sector perspective, which is the non-manufacturing PMI, it's also kind of, yeah, it's still in expansionary mode at 50.3, almost up by 50 point, slightly by 50.2, then more or less being consensus as well. Okay, so if you look at the trend of the services sector or the non-manufacturing sector, so that actually kind of give us a gauge of internal demand or consumption demand in China. So it's also kind of lackluster as well. Okay, yes, it's slowly inching upwards, but it's not that great at all. All right, so it may be like plateauing at around the 50 level mark. All right, yes, it's growing, but it's not growing in a kind of very strong accelerated phase. And also in China, on Saturday, okay, pardon me, yeah, this one on Saturday, they also released this kind of it's done by this China Real Estate Information Corporation, where they released the value of new home sales from the 100 biggest real estate China company, which fell to a 2.6% year on year. So what we could see over here is that since March this year, based on this trend at negative 70% year on year, it continued to plateau down to negative 26% year on year. So what we could see over here is that despite this piecemeal of fiscal stimulus measure and also monetary policy measure to improve consumer and business confidence in China, it doesn't seem to have a positive impact on the China real estate market as growth continues to temper off since hitting a high of negative 17% in March as being compiled by this data of this value of new home sales from the 100 biggest real estate company by this data provider, China Real Estate Information Corp, as reported by Bloomberg. So what we could see at this point in time, there is this very, very weak form of economic growth in China, real estate market not doing any form of clear basing formation, and we know that the Chinese real estate market over here form a significant bulk of Chinese wealth, and it could also potentially lead to a knockoff or a kind of a negative feedback loop in terms of sentiment, and that could potentially also see internal consumer demand starts to sluggish as well. That is being portrayed by the latest MBS non-manufacturing PMI data that I share with you all. No clear sign of acceleration in growth, and that could also keep market participants on the edge with that deflationary narrative starts playing back again and again into the China stock market. So that's why we start to see the China stock market and the Hang Seng Index open much lower in today's Asia session. Okay, later I'll talk more about that when we cover the short-term intraday technical outlook on the Hang Seng Index. And one more data, one more event over the weekend that took place will be more pertaining to the euro dollar that could see much form of the euro dollar softness and the German 30 index to do a bit of retracement after hitting a fresh all-time intraday high, or almost, I would say almost hit on last Friday, is due to the current correlation, centralist correlation. They actually lose out in one of the regional electorate poll, where the far right AFD is on the course of winning a regional ballot for the first time. All right, so what it actually seems over here is that it seems to be playing out that kind of far right political party in Europe, gaining a kind of a cornerstone in terms of economic voice that is being cemented since the kind of a Le Pen far right party in France managed to actually gain a significant foothold as well. That was actually took shape about 2.5 months ago, and is playing out the same story in Germany right now. So for that, with that, that could actually impact a bit of kind of, at least from a short-term perspective or intraday perspective, euro weakness, and that could translate a bit of what I call potential negative retracement decline, at least in the short-term perspective for the German 30. So later I'll talk much more about that when I cover the German 30 intraday short-term technical outlook. All right, so with that potentially sums up the news flow and its impact, latest news flow events and its impact on the various cross asset classes. So now let me share with you a fundamental and intermarket perspective right now. So as we know that the US Treasury yield has a potential impact on the FX market from a dollar uh, from FX market. Why? Because of a US dollar yield premium perspective. That means if the US Treasury yield continue to plunge lower, US Treasury yield premium against the rest of our strings, and that actually lead to less incentive for traders or investors to hold US related assets like the US Treasury, and that could potentially put downside pressure on the US dollar, like what it did about one month ago in the month of August. So what we could see over here at this point in time, this is the 2-year Treasury yield. Ever since hitting the low of 5th of August at very close to the 3.6% long-term pivotal support, it started to shape in a kind of a very consolidation mode. And what we could see over here is that the RSI now has started to clear above its oversold level by printing a series of higher low. So, and also if you were to actually look at from a perspective over here, okay, it seems to us now is actually testing this kind of parallel resistance that I draw from the high of the RSI in the previous overbought region. So net overall, it could potentially now start to see a kind of mean reversion play that could start to unfold in the 2-year Treasury yield. That means potentially further bounce towards the next intermediate resistance zone of 4.03% and 4.12%. Okay, at this particular rate zone over here. So net, and if it starts to clear above 4.12%, we could start to see the next resistance zone coming in. Let me put it in red again. 4.34% and 4.42%, which is very close to the 50-day moving average as well. Okay, so with this potential mean reversion rebound in play in the 2-year Treasury yield, that could also support last Friday ongoing rebound that is being seen on the US dollar in general. Okay, so that's the 2-year. And if you look at the longer tenure, the 10-year is also doing very similar kind of formation after it can't break below the key medium-term support at 3.78%. Okay, and it already surpassed the 20-day moving average. All right, whilst the 2-year hasn't surpassed yet. So net overall, it also starts potentially could shape this ongoing mean reversion rebound in the 10-year. All right, with the next resistance coming in at 4% and this level here, 4.08%, this resistance zone. Okay, that means implying that this mean reversion rebound potentially still has room to move up. And what we could see over here is that the RSI now also exit from the oversold region after printing a series of higher low. And if you could draw a parallel resistance from the previous overbought level, okay, it's now testing this parallel resistance as well, and seems to be one potentially breaking up above it by the series of higher low that's being printed out after exiting from the oversold region. So given that both the shorter tenure 2-year and the longer tenure 10-year US Treasury is shaping potential rebound after can't break above their respective key support level, i.e. We could start to see some form of at least short-term rebound back into the US dollar in the dollar FX market, and that could also being played out on the technical chart of the dollar index. So this is the daily chart of the dollar index. So what you could see over here is that this was the huge plummet that was seen throughout the month of August until over here it can't really break below 100.80, which is this kind of minus swing low area over here, medium term swing low area, and the swing low area of 28th of December, kind of a failure breakdown before recovering. And interestingly, what we could see over here is that the RSI has starts to exit out from the oversold region, all right, after printing this bullish divergence over here. Okay, higher low, a series of higher low. Okay, higher low, higher low, higher low, whereas the price action continues to actually inch downwards over here at this juncture. So net overall, what we could see over here is that that bounce in the 2-year treasury yield and the bounce in the 10-year treasury yield, at least from a multi-day perspective, is now being translated as well into this ongoing mean reversion corrective rebound or bounce that potentially could unfold in the US dollar index. That means potentially we may see some form of dollar strength coming back in the short term in terms of the multi-day perspective, since it's a daily chart, with the next intermediate resistance zone to watch out for will be 102.20 and 102.73, which is very close to the 20-day moving average, acting as a resistance, and as well as this former medium term range symmetrical triangle range support from the low of 14th of July this year now turns into a pullback resistance zone as well. Right, so that is the intermarket perspective. That means what we are looking at right now from a short-term perspective after that dramatic fall of the US dollar index, that means dollar weakness. And right now, we know that price action do not move one way in a vertical fashion. It seems to us that based on an intermarket perspective, at least from a multi-day perspective or a short-term perspective, we may potentially see some form of dollar rebound coming back into the FX market. All right, so that covers the fundamental and the intermarket dynamics on share for today. So with that, let me expand my screen so that you guys could see the key levels right now as we continue our daily dose. And right now, our focus will be on the intraday technical outlook, starting on the FX market first. All right, so let me tally up my chart. Okay, so now let us focus our attention to the euro dollar. Okay, so the euro dollar last Friday, we do have a neutrality stance. The lower neutrality limit is the 110.50 level, and also the 20-day moving average at this juncture. And also, given that we know that last expressed to you earlier on, in terms of the intermarket perspective, there could be some form of dollar rebound coming back into the picture, and as well as we know that the political situation in Germany doesn't gel well for the current incumbent government. That means the far right party may gain a foothold in this regional election in Germany, and that could also potentially see a bit of negative feedback loop into the euro. All right, that means a bit of euro softness. So with that, we will flip to a bearish bias on the euro dollar using 110.05 as my short-term pivotal resistance level. As long as this level holds, and very clearly a breakdown below 110.50, which is all correspond to the current Asia session low right now, may see an extension of this corrective decline to expose the next near-term support at the 110 figure level, and below it exposes 1.0950, which correspond to the rising 50-day moving average, coming to act as a support level as well. Only an hourly close above 111.05, which is today's short-term pivotal resistance on the euro dollar, will invalidate today's intraday bearish bias to see a recovery, at least in short term on the intraday basis, towards 111.40. Then thereafter, on last 2 Friday high, that means 2 weeks ago high at 112 figure level. Right, so that is for the euro dollar. And given the weakness of the euro dollar, it also starts to spread into the sterling dollar as well. So I'll be using 131.90. So on last Friday, we were neutral on the sterling dollar. So given the fact that the intermarket dynamics is supporting a kind of a short-term dollar rebound narrative, so with that, I'll be using 131.90 as my short-term pivotal resistance level on the sterling dollar for today. Flip to a short-term intraday bearish bias with near-term support level to watch will be at 130.80 followed by 130.40. A breakdown below it exposes 129.70, which correspond to this rising 20-day moving average as well. Only an hourly close above 131.90 will invalidate today's intraday bearish bias to see the recovery of this sterling dollar strength against the dollar to revisit 2 weeks high last 28th of August, last Wednesday high at 1.2965, and above it sees 133.40 next in terms of the we call it a short-term intraday technical outlook. So that sum up the European currency. Let us focus our attention to the Asia Pac currency against the dollar. So if you look at the Aussie dollar on last Friday, it actually fall short of our resistance level that we highlighted at 68.50. So it just printed a high of 68.21 before plunging down and broke below this minor ascending channel support that I drew from the high low of 6th of August. All right, 6th of August. So with this breakdown over here, I'll be using last Friday high at 68.20. Right now, potentially there could be some form of a rebound taking shape, given that the hourly RSI has exited from the oversold region. Okay, first resistance level to watch. Okay, we'll be very close to this level here. The pullback of the channel. Resistance at 67.93, but still using last Friday high as the short-term pivotal resistance, 68.20. So as long as the price action did surpass 68.20, we will flip to a short-term intraday bearish bias on the Aussie dollar to kickstart a potential kind of a mean reversion decline to retrace this short-term uptrend that has taken shape from 5th of August low all the way up to last Thursday minor swing high, okay, or Friday swing high, which is very close at 68.20 over here. Support level to watch in the near term, 67 figure level. A break below 67 figure level exposes 66.40 next. But however, if price starts to shape a bullish breakout above 68.20 with hourly close above it, then we will see the continuation of this minor uptrend phase for the Aussie dollar to revisit 68.50 and 68.90/69 figure level. Okay, so that's for the Aussie dollar. Dollar yen. So I could see dollar yen very interesting. The hourly RSI has started, not the hourly, the daily RSI. So this is the daily chart itself. Okay, let me push it down. Okay, this is the daily chart. Okay, of the dollar yen. Okay, let me remove all this resistance level. Okay, the dollar yen. Okay, so I could see this dollar yen over here at this juncture. Okay, the daily RSI has started to shape a kind of higher low. Okay, very obvious there's a higher low here, whereas we start to see similar low on the dollar yen. Okay, same low, almost same low. Okay, in not taking into account of the wicks over here. That means in terms of the body of the candle, similar low, but higher, very clear higher low on the RSI. So what we could see at this juncture is that this medium-term decline from 11th of July all the way up to the 5th of August, close to about 1 month of decline. So that's medium term. The dollar yen now is in the process of doing that mean reversion rebound scenario, and potentially the first resistance level to watch out for, okay, will be the swing, this level here, 149.30, 149.95. Okay, also very close to this 200-day moving average, I think, as a resistance over here, and also this former dotted gray line, which is the major ascending channel support from the low of 16th of Jan last year, now turns into a pullback resistance at around this 149.95 level. So from a intraday perspective, what we could see now is that there could be some form of further potential rebound towards this resistance zone, okay, at this juncture, based on the latest current technical element that supports this potential mean reversion scenario playing out on the dollar yen as depicted on the daily chart. So what are the key levels to watch on the intraday basis? So we know that last Friday we do have a very tight 145.45 short-term pivotal resistance, looking for it to retest 143.70. So it didn't take shape. Instead, price action pierced up and hit the next resistance at 146.50 before shaping that minor pullback right now, and also with the hourly RSI exiting from the overbought level, and it has really taken shape. Okay, so right now, given the fact that it may start to dip slightly lower before coming close to the oversold region, and that also being depicted by a much more sensitive oscillator, which is the stochastic as well. Okay, also exiting from the overbought level, hasn't hit the oversold region yet. So with that, I'll be placing a slightly lower short-term pivotal support level at 145.15. Okay, in fact, I'll give it a zone, taking into account this zone over here. Okay, this particular level. Okay, this zone here. Okay, 144.4546. Okay, so this is the zone. Okay, so as long as this zone holds in terms of the pullback, potential pullback, given that it hasn't reached the oversold zone yet on the hourly RSI and the hourly stochastic, as long as this 145.15, 144.46 short-term pivotal zone holds, potentially this dollar yen could still see potential miss of a potential, what you call it, leg of this mean reversion rebound taking shape. Above 146.50 exposes 147.50 next in short term, followed by 149.30. Only a breakdown below 144.46, then that could actually potentially see the resumption of its bearish impulsive move to retest 143.70 and below its revisit the 5th of August swing low area at around 14160/40. Okay, so that's for the dollar yen. And right now, for today, I will share some potential FX market FX crosses. As we know that FX market, we could actually remove the dollar to take into consideration of some of the FX cross pair. So one of the FX cross pair I want to highlight for you all for this today on Monday will be the euro dollar in a very short term perspective as well. So for the euro dollar in a very, so this is basically taking into the relative strength of the euro versus the sterling. So we know that both of them are expressing dollar weakness in some form or another, but if you take into account of euro versus the sterling, the euro has been very weak since 8th of August, since almost the start of the month of August, all the way down towards the end of August, which is last Friday, trading inside this minor descending channel as being depicted on the euro dollar or euro sterling, pardon me, euro sterling 1 hour chart. But what you could see over here is that the price action really hit the lower boundary of the descending channel. So we know that after hitting lower boundary of descending channel, there could be a form of mean reversion if the hourly RSI starts to show this kind of bullish divergence, which has taken shape. So I'll be using the 83.97, 83.97 slash 83.87. Okay, so it's a zone, 83.87. Okay, 83.97 slash 83.87 short-term pivotal support level for the euro sterling, which is also the lower limit of this minor descending channel, and as well as this swing low area of 13th of July and 25th of July over here at this point in time where it bounces. Potentially there could be a short-term intraday mean reversion rebound playing out on the euro sterling. Intermediate resistance to watch out for on an intraday basis will be 84.50 followed by 84.75, which correspond to the 50-day moving average acting as a resistance and also close to the upper limit of this minor descending channel. So only a price breakdown with an hourly close below 83.87, then this mean reversion rebound scenario will be invalidated, where we could see the continuation of this impulsive down move within its a minor downtrend phase to actually expose the next resistance, next support level, pardon me, at 83.40. So this 83.40 is in fact a medium-term swing low of 1st of August last year, 2 years ago, not last year, 2 years ago, 1st of August low at 2022. All right, so that sum up the kind of a intraday technical outlook on the FX cross market, for highlighting the euro sterling FX cross pair. Right, so with that, now let us turn our attention to the major stock indices in terms of their intraday technical outlook perspective, starting with the Hong Kong 33 or the Hang Seng Index. So the Hang Seng Index, what we could see over here is that last Friday, we do have a very tight short-term pivotal support at 17,745, and it has already broken below it in today's Asia session, taking into account of the very lackluster MBS manufacturing PMI and non-manufacturing PMI data for the month of August that was released on Saturday. So with that, I'll be using last Friday US session high and also very close to today's Asia session high at the opening, which is 17,870 level. Use this as my short-term pivotal resistance level on the Hong Kong 33. So we will flip to a short-term intraday bearish bias. Potentially, it could revisit the minor swing low of 29th of August, which confluence with the 50-day moving average acting as a support, and the 20-day moving average acting as a support as well at this next support zone of 17,540 slash 17,430, this zone over here. But however, a breakdown below this 17,430 lower limit of this intermediate support zone exposes the 200-day moving average, which confluencing at the next support zone at 17,270 slash 17,185. And if we take into account of the Fibo retracement of this prior push-up, okay, it also corresponds very closely to the 38% and the 50% Fibo retracement as well in those graphical next near-term support zone that we highlighted. Okay, but however, if price action managed to reverse up and have an hourly close above 17,870, then that will invalidate today's intraday bearish bias to see the continuation of this kind of short-term mean reversion rebound scenario taking shape within a major short-term mean reversion rebound scenario extending, I would say, to retest 80,070 slash 80,160, and above it see the minor swing high of 12th of July at 18,350 next. Okay, so that's for the Hong Kong 33. And right now, what we have on the Japan 225. So Japan 225 on last Friday, we were bullish. It really hit our first resistance at 39,270 almost. So on last Friday, it printed. Okay, so on last Friday, in fact, in today's Asia session high, right at the opening, it printed a high of 39,179. So almost more or less hit the 39,270 resistance that we highlighted on last Friday. So using this last Friday resistance now turns into a short-term pivotal resistance, there could be a risk of a mean reversion decline scenario unfolding to retrace this some portion of the gains that was from this ongoing minor uptrend phase from 5th of August all the way up to this morning Asia session high. So the next support level to watch will be a breakdown below 38,280, exposes the 200-day moving average at 37,480. Below it exceeds the 20-day moving average, confluencing as the next graphical support zone in near term at 36,885 slash 36,630. Only a breakout with an hourly close above 39,270 will invalidate today's bearish bias on the mean reversion decline scenario to see the continuation of the impulsive up move to test the next near-term resistance zone of 40,055, followed by 40,440 next, which is this congestion area over here. Okay, from 20th of July to 23rd of July and 18th of July to 19th of July this year. So that's for the Japan 225. Now, moving our focus now on the German 30 or the German DAX, which is one of the major European stock indices. So on last Friday, it almost hit, it keep on testing the current fresh all-time high at 18,935 over here. Okay, so that's the fresh all-time high. And what we could see over here is that the hourly RSI has started to print out a series of lower high. Okay, so this is a bearish divergence. So indicating that this ongoing minor uptrend phase that is in shape since 5th of August is losing upside momentum. So it increases the risk of at least a mean reversion decline in the short term to retrace certain portion of this minor uptrend phase. Okay, that is in place since 5th of August. So with that, I'll be using 19,025 as my short-term pivotal resistance for today on the German 30, flip to a short-term intraday bearish bias for that potential mean reversion decline scenario to play out. First near-term support level to watch on the intraday basis, 18,820, that is last Friday low. A breakdown below it exposes 18,550 and potentially 18,350, which correspond to this 50-day moving average, acting as a support level as well, right? And if we do the Fibo retracement of this entire up move from here, okay, that corresponds very closely to the 38% Fibo, slightly lower at 18,210. Okay, almost the 38% Fibo retracement. Okay, only an hourly close above 19,025 will invalidate today's intraday bearish bias on the mean reversion decline scenario to see the continuation of the impulsive move to expose the next resistance level at 19,170, followed by 19,330 / 19,370 on the German 30. So now, what's cooking for the major US stock indices? So on the major US stock indices, there is no clear signs of, starting with the US Wall Street 30 first, pardon me, there's no clear sign of a clear bearish exhaustion. Still no change. Last Friday, price action managed to bounce off exactly at the Titan 4160 short-term pivotal support level, and it hit the first resistance level that we highlighted, 41,535 again, before before trading sideways now in the Asia session. All right, Asia session it didn't move actually that much. So with that, no change. Still using 41,060 as my short-term pivotal support level in any form of a pullback. As long as this pullback didn't break below 41,060, we still maintain that short-term intraday bullish bias on the US Wall Street 30. Next near-term resistance level to watch after 41,535 will be at 41,800 next. Okay, then thereafter breakout exposes 42,130, which is a 0.618 Fibo extension level. Only an hourly close below 4160 will invalidate today's intraday bullish bias to potentially kickstart a mean reversion decline scenario as well. 4870 followed by 4060 next, all right, which coming very close to the rising 20-day moving average, I think, as a support. So that's for the US Wall Street 30. Up next will be the Nasdaq 100. So the Nasdaq 100 continues to be trapped, can't break above the intermediate resistance zone that we highlighted since after exposed Nvidia earnings results on last Wednesday, 19,630. So we can't actually tighten the key short-term pivotal support level. Okay, so at most we give it as a first support level to watch for any form of a pullback will be at this minor support area here at 19,350, but still using the all-important 20-day moving average, where it actually managed to survive right after Nvidia earnings result before that recovery, okay, at 19,630, which is the minor swing high area of 20th August. So as long as 19,117 short-term pivotal support holds, no change from last Friday, we will still maintain that short-term intraday bullish bias on the Nasdaq 100, but it got to break out above 19,630 in order to revisit its 22nd of August minor swing high area at 19,900. Only an hourly close breakdown below 19,117 will kickstart another form of a short-term mean reversion decline scenario to expose the next support level at 18,680 and potentially even 18,320, which confluence with the very closely to the 200-day moving average. All right, so that sum up the intraday technical outlook on the major stock indices. So now focus our attention to the key commodities market, starting with gold XAU/USD. So no change for gold, as you could see that it can't break above 2,532, but still continues to hover above the rising 20-day moving average, and also playing around the psychological level at around the 2,500 level mark over here. Okay, so if you look at the 2005 level mark, there has been support. There has been, I think, as a very short-term support since last Wednesday. All right, going to play around this level, but this level we do not want to put it as a short-term pivotal support because not enough technical elements to support as a pivotal support. Why? Because this 273 is much more important. There are two key elements that's pointing to this level: the 20-day moving average acting as support, and this purple line here, which was a former range resistance, now turns into a pullback support level. So it was a range resistance since 18th of July and 2nd of August, now turns to a very key short-term pivotal support level. So no change, using 273 as my short-term pivotal support level. Still maintain that short-term intraday bullish bias on gold, kind of win a range scenario, kind of a minor range scenario that is in place since 20th of August, which is at 2,532. Only a breakout above 2,532 potentially sees the return of the impulsive up move to create a potential push up towards the next near-term resistance zone, or next intermediate resistance zone, I would say, at 2,588/2,595. Only an hourly close below 2,473 will see a start of a mean reversion rebound scenario, a mean reversion decline scenario, pardon me, not rebound, a mean reversion decline scenario towards the 50-day moving average that is acting as a support level as well. That's confluence with the next near-term support zone at 2,435/2,415. Okay, so that's for gold, XAU/USD. Now, moving our attention next will be the West Texas crude oil, WTI crude. So WTI crude was very negative on last Friday, and it continues to plunge back down below the 20-day moving average, broke below Wednesday minor swing low, and right now coming very close to the medium term symmetrical triangle range support again, as you can see on the daily chart over here, the 73.15 level. All right, this level here. Okay, there was a symmetrical triangle range support that is in place since 20th of March 2023. So with that, now backing at the symmetrical triangle range support level, that's very close to it, and with the RSI already dipping down to the oversold region as well, there could be some form at least of a minor bounce taking shape, as long as this symmetrical triangle range support holds. So on the intraday basis, we'll be using 73.15, 72.24, a bit of excess, which is the minor swing low of 5th of August. So this will be today's short-term pivotal support zone to watch, to have a short-term potential intraday bias, bullish bias for that bounce to take shape very close to the short-term very close to the medium-term symmetrical triangle range support level, where prior bounces managed to actually occur as well previously, on the most recent one on the 22nd of August. All right, first near-term resistance level to watch will be at 75.06, followed by the 20-day moving average acting as a resistance at 76.45. Only a breakdown with an hourly close below 72.24, then this bounce scenario will be invalidated to see the continuation of further potential weakness on West Texas oil to expose us the next near-term support level on the intraday basis at 71.35, followed by 70.40. All right, so 70.40, if we go to the daily time frame, okay, it will be this minus medium-term swing low area of 29th of December and 9th of January. Okay, so that sum up the short-term intraday technical outlook on the major cross asset classes. So before we go today, let's take a quick look at the economic calendar. What are the key data to look out for today? Okay, so very quickly on the economic calendar. So for today, in the European session will be rather quiet, except for that during the US session, there'll be one official Eurozone official speaking, which is ECB Budge speech at 9 p.m. Singapore time. And today will also be a US public holiday as well. So potentially we also see a lesser liquidity in the broad-based cross asset classes as we head into the US session due to a Labor Day break in the US. And we also not see any US data release for today as well. So for tomorrow Asia session, there'll be no key economic data to take note of. All right. So with that, that sum up today's Daily Dose of Market Insights. I'm Kelvin here, signing off. Wishing you all a great day ahead, and we shall speak again tomorrow. Thank you.